Hello everyone and welcome back to a new video. My name is John and today we're going to talk about Coastal Contracts, an oil and gas player that is not so much involved in Malaysia but more so in Mexico currently. It's seen quite a bit of a rise in its share price in 2022, so we're going to find out the nature of their business, take a look at the financials, their revenue segmentation and breakdown, and last but not least, evaluate the risks involved if you were to invest in this company. So stay till the end of the video to find out my thoughts. So first up, what is Coastal Contracts' business model? They're an oil field service provider that actually leases or rents equipment, either in terms of a gas compression facility or an offshore support vessel or a barge or a jackup rig, over to exploration and production players like Pemex of Mexico. Now, Pemex is the national oil company of Mexico. If you were to draw parallels to that, that would be a Petronas in Malaysia or someone like a Hibiscus. Now, Hibiscus actually has production sharing contracts with the national oil company like Petronas, and they take a particular field into custodianship for like 20 to 25 years, operate the field, and then return it back to the PSC provider, in this case Petronas. Similarly, for Coastal Contracts, they're actually serving Pemex that has a particular concession on a field with either themselves or their partners who jointly operate the field, provide capex costs, provide project development costs. Now, Coastal Contracts did not start off that way. They actually started off with more of an offshore service vessel, vessels similar to this, if you can see on the screen right now, over to many oil and gas companies that had offshore operations. They even supplied barges, but they really started by shipbuilding and leasing vessels rather than providing engineering services or even leases of gas compression facilities like what they're doing today. So a little bit of an adjacent pivot, in my opinion, but they did cut their teeth into engineering and construction of ships, which is actually their forte. Now you'll be wondering, how did they get this expertise either overnight or over the years? Shipbuilding, I mean, from my experience working in Shell, shipbuilding and oil and gas, offshore oil and gas fabrication work has a lot of similarities to it. That's why a lot of offshore facilities are actually fabricated in shipyards, like Goje Island, the Samsung heavy shipyard. And in Malaysia, you have the Lumut shipyard that belongs to Kencana, or now Sapura, and also MMHE down in Johor. So these are actually the players, and Coastal is more now into an EPCC player, especially more for onshore gas processing facilities. Now, their foray into Mexico was really based on this particular piece of equipment, or the right term for it would be a jutsu. Okay, so it stands for Jack Up, JU, G, Gas Compression Service Unit. Okay, so I don't know whether I pronounce it correctly, Jutsu. And their foray, in somewhere circa 2014, they signed a 12-year deal to actually provide this jackup gas compression service unit over to an offshore field to actually process gas and to re-inject it back into the field, so that that particular facility, which was producing more oil, would not have to flare the gas. Now, why is this important? Because a lot of this gas, once it's flared, is environmentally not good, and you also waste a lot of money. Because in the past, if you followed some of my videos where I explained that a lot of fields were actually developed for oil production facilities based on oil production prioritization, but a lot of this associated gas that comes from this production, they don't know what to do with it. And why they don't know what to do with it? Because the platforms are located in the middle of the sea, and there's no way to store it, there's no way to refrigerate it. Further, there's no pipe to actually pipe a lot of these back to shore, because building a pipe involves more money. And if there is no onshore gas processing plant at that point of time, then it makes no economic sense to actually pipe the gas back to shore as well. This phenomena is actually very predominant. I mean, I could go on and on, but in Malaysia, we even have that happening because a lot of oil production facilities over in Sabah, where predominantly the production is oil, a lot of the associated gases that comes out of those oil fields, they don't know where to go. It's either piped back through a long pipe all the way down to Bintulu. Yes, they actually pipe it all the way down to Bintulu because there's an LNG facility there. And in Pemex case, Cantarell, the field where this Augusta 12 is actually operating, it's a very old facility. I do not know the architecture of the pipes or the network of the pipes that actually feed into this facility, but I'm guessing they did not have all this. That's why they were flaring, and to the tune of about 600 million 600 million meter cube of metric, 600 CFD of gas, which is a lot. Just to give you context, right? 600 million standard cubic feet of gas is probably equivalent to one production facility in Malaysia. I repeat, the amount of gas that they are flaring is probably equivalent to the production of one gas facility in Malaysia. Yes, that's how much gas they are flaring. So when I read the stats, I'm like, wow, there's a lot of money being burned up in the air, right? So I guess it's wise for Pemex to actually engage someone to build that jutsu for them and to utilize those gas rather than just to flare it. So upon securing that jutsu of Augusta 12 on the Cantarell field with a 12-year contract and currently into the 6-year, they expanded their foray into onshore gas fields. And in this case, they have two plants. One is already running, which is the Perdiz plant. The other is the EMC Papan gas processing facility, which they target to complete in second quarter of 2023. Now, both these plants actually operate on the Isashi field, discovered in 2017, one of the largest fields that Mexico has discovered in recent times. And prior to this, the Cantarell field, which was the largest for Mexico, is actually already on a decline. And I think this augurs well for Coastal because by their experience constructing Perdiz and also EMC Papan, they now know the local nuances, the local culture, how to work with contractors through their JV, their 50-50 JV with a local partner over there. I think it does put them a little bit on a front seat kind of role to secure more contracts because now you've won over the trust, you've built a relationship with Pemex, people looked at you, you've delivered on your track record, and it's something that people can't take away from you, that credibility there. It's not easy, especially in oil and gas. Many projects have failed and they had to bring in external parties to try to salvage the project. And it's more common than you know because of the technical difficulties, engineering difficulties, sometimes in constructing plants within the oil and gas sector. And that's why the big players have an edge because of this accumulated domain knowledge. And in this case, I think it's a move in the right direction for Coastal. So now let's look at the financials. Prior to this, as I mentioned, Coastal was in a very tough segment of the business, leasing of vessels, leasing of jackups, leasing of manpower barges. And that business is pretty brutal because if you are in a growth state for the oil and gas industry where rates are rising, then you can maintain a certain lease rate to your clients and yet still make money because you have to finance these projects. You have to finance not the projects. You have to finance these vessels and assets that you are leasing to them. And that was one of the troubles that actually hit Sapura because they were buying all these very, very expensive vessels and they couldn't secure contracts or the lease rates were coming down. And therefore, you are saddled with all this debt on a depreciating asset. And I think this is something that no matter how good you are as an operator, it's a tough business, right? And because of their pivot over to build, engineer, and operate, and with a leasing term, I think it augurs well as more of a recurring revenue over to Coastal. And you can see quite evidently, I think 2018 was very brutal to them with this kind of net loss of 583 million. Okay, it's things starting to shape up, especially in 2021. and 2022. I think this was when, their Jutsu started, giving them some kind of visibility of earnings. And then they were securing all these gas plants, engineering and leasing. That's where if I didn't drag it back to 2016, I think their revenue at that point of time was about 2 billion, right? So you see, that's where management is key on how you want to pivot, how you want to, secure some sort of a more, rather than lumpy kind of revenue, it's more of a recurring nature. As you can see, this is actually more evident of their revenue contribution, them getting out of their shipbuilding, ship repairs, right? I mean, in 2020, it was virtually non-existent, and then 2021, that's it, man. Vessel chartering still remains. There's a small chunk, but not as big. I mean, 2020 COVID years, 2021 was even worse, but that's where their recurring revenue gas processing facility started, channeling it back to them. And, hopefully this can be sustainable going forward, because that's a more visible kind of earnings contribution. Prospects going forward for Coastal. Currently, there are only 2 Jutsus being operated in Pemex. And the requirement is actually 8. So there's actually another 6 that needs to be built and to be operated and to be leased. So that's additional prospects for Coastal. The second growth prospect is the additional gas processing plants for the Isashi field. So you never know. As I said earlier, because Coastal has already built some kind of domain knowledge over in Mexico, local regulation, local contractor culture, and all that kind of thing. And they built this through that JV with Nuvoil Group, which is a very established Mexican oil and gas player in Mexico. So the Perdiz and the Papan is actually built in with operate and maintain. That's why O&M is there, and operate and maintain contracts, which ends in February 2024, so 1 more year to go. And there's a minimal contractual offtake for the gas. So that means they will build the plant, all right? They will operate it, and Pemex, think of it like you build electrical generation facility like a hydropower plant. And in this case, they are building a gas facility, and there is actually a minimum offtake. That means Pemex has to take a minimum quantity of gas from these 2 facilities, right? So we don't know whether they will win. The Nuvoil JV with Coastal will actually win more gas processing contracts, but it's something that obviously they are optimistic about because of their built relationship that they already have with Pemex. Last but not least is the risk. Obviously, customer concentration risk is high up there because there's only one, right? Pemex. And the counterparty risk is real because, touch wood, hopefully Pemex doesn't go into default. They're a national oil company, but they are not as well managed. I mean, if I were to benchmark the Petronas, say what you may about Malaysia not being economically savvy, but Petronas, our national oil company, is one of the best well-managed oil and gas companies in the world, right? And even though Pemex is huge in terms of size and reserves that they have, it's not been as well managed as some of the best, right? Let's put it this way. The second risk I see is the escalation of project cost. Now, there's a bit of a rise in oil and gas coming back. Even with all these ESG teams, people realize that there is a sustainable energy demand and it's not being met as economically viable by all this renewable energy. So therefore, people are looking back at more cost-effective oil and gas projects. And because of that, when there's more demand, oil prices are elevated, there is a risk of escalation of project costs. Now, the third risk is actually related to their JV with Nuvoil. If they don't maintain a good relationship and somehow, somewhere, something just flares up, that would derail a lot of their growth potential in Mexico. The fourth, early termination of the existing contracts, which I see is not that probable from my point of view. Oil and gas projects, the moment you want to terminate, right, you have to think of who else is available to come in at such short notice, to come in with that financial might to be able to take over that contract. It's not easy unless you really screw it up big time. Based on what we've seen, the track record of Coastal, I leave it to you to read in between the lines. Fifth, finance cost increase, rising interest rate environment, true for any oil and gas player, which requires a lot of capex money upfront, right? And you're not going to have cash on standby to finance these projects, right? Last but not least, material shortage related to escalation of project costs. The moment oil and gas activity picks up, the rates will increase, material price will increase, and demand for it will increase. And, it could be a bottleneck. So there you go, my thoughts on coastal contracts. Price has gone up by quite a bit. Has it been fully valued, baked in? I leave it to you after showing you their business model and their future prospects. And more importantly, if you enjoy content like this, give it a subscribe, my channel, give it a like, share this with friends and family, those who want to be a better investor like you. And last but not least, hit that notification bell so that you know when the new videos are out. See you guys in the next video. Happy New Year. I'll be taking a break for next week, so you won't be seeing any videos on Monday. But let's see, you may have a surprise on the podcast that may be coming out on Tuesday.